The yen carry trade has been in headlines recently, with some analysts citing the popular investment strategy as a reason for the volatility that we've seen recently in global markets. With that in mind, we're going to discuss the yen carry trade, how much money was part of it, and if it could cause further disruptions to markets. We're going to do that right now on UBS Trending. Hi, everybody, and welcome to UBS Trending. I'm your host, Anthony Pastore, and I'm welcoming to the studio today my colleague from the Chief Investment Office, Kurt Reimann. Kurt, good to have you here.
It's good to be here, Anthony.
If you look at the headlines from the volatility that took place over a little over a week ago, that the yen carry trade may have been a part of that volatility. So let's level set. What is that carry trade?
Imagine two banks, two neighborhood banks. One bank has a low interest rate. Another bank has a high interest rate, both on what they pay borrowers and what they lend out. So imagine you could go to one bank and you could borrow money at a low interest rate. Great. So you just borrowed some money. What are you going to do with it? Well, most likely you're going to take that money and bring it over to the other bank and earn a higher interest rate. That doesn't exist in the real world, but the carry trade has a more interesting effect, especially when you layer on currency moves.
Right.
Imagine if you could pay back that bank that you borrowed money from less money than you borrowed. That would not work. Business models would not allow it. Banks would fail. So in this hypothetical example, that's all it is. But if we go into a world where we're talking about different countries that have different economic profiles, that have different inflation rates, different growth rates, different monetary policy, this is possible. What happens in the yen carry trade is that investors borrow from a low yielding country, like in this case, Japan. Mm-hmm. And what they would do is they would take those proceeds and they would invest them overseas, somewhere else, somewhere not in Japan usually, and in a higher yielding environment. One example is US dollar denominated treasury bonds, which, as you've been seeing lately, the bills market has been paying 5.25%, 5.5% in that range. That's a pretty good difference. That's a difference enough to make this lucrative. Mm-hmm. Okay, well, what if you layer on top of that the yen weakening? What does that mean? That means when you have to go and pay back your loan, you're paying back in fewer, same amount of yen, but it's just costing you less because the dollar's worth more.
Right.
So that's this neighborhood bank analogy translated into the real world, and it's been happening. We've been seeing the yen weaken structurally since 2022. We've had, as you know, structurally different interest rates. So this has been going on for a while. It's been building up for a while because this isn't the world of an individual investor. This is not something that we all would be trafficking in.
Right.
But for some larger investors that have the ability to transact overseas, this is almost like an easy money.
Well, this isn't a new phenomenon, right, Kurt? I mean, this is something that's been going on for decades and generations. Yeah. And so when was the last time we saw a carry trade kind of maybe cause a little bit of a stir in the markets like the one that we're talking about today did just over a week ago?
Well, there were discussions back in the financial crisis before the financial crisis got really full blown. There were these distortions in currency markets, just like we see today, where the yen was ridiculously weak. And so there was this imbalance in currency markets. And if you were looking at these imbalances, you could have said, well, this might actually lead to a risk-off mode.
Yeah.
Well, we had a risk-off mode. It wasn't really because we had imbalances in the currency markets, as we all know now. It was because of the global financial crisis and the toxic assets that existed in the world. What I wonder about, though, right now is in this time travel back, in a way, if you will, to another period when there was a yen carry trade, if investors aren't thinking, well, bad things happened then in 2007. Isn't it possible that bad things can happen
again
now? And we would caution against maybe making that type of comparison. The world is very different.
Yeah.
So yeah.
And there are a lot more protections in place and curbs in place and balance, checks and balances with the banks. And so here's the question I think a lot of people are wondering. Although I can safely say, since we're sitting here, since the worst of the volatility over a week ago, and it really was only 2 or 3 sessions, it's been a little calmer in the markets. But are we out of the woods yet when it comes to the vol and this carry trade? It doesn't just go away overnight, but
Yeah.
how far are we from it happening again?
So just a little bit of background on what happened coming into that, call it weekend, or extended long summer vacation weekend. We also had kind of a weak employment report for the month of July that was released at the end of the week on that Friday in August. Anyway, in currencies, you have to always remember, it's not just what happens in one place, it's what happens in both places. And here, what you had was all of a sudden expectations that the Fed was going to cut interest rates more aggressively. So we were talking about that example before, 2 banks, one with a low interest rate, one with a high interest rate. What happened in the world of finance is that that interest rate in Japan was expected to go higher, and the interest rate in the US was expected to go lower. So that was starting to converge. And we have a chart that shows this. It shows that the difference, it's showing 10-year note yield, so it's not policy rates, but it shows you, as we were getting into the latter part of July and into early August, that differential between the US 10-year and the Japanese JGB, or Japanese government bond 10-year, narrowed even more.
Yeah.
And so that prompted the volatility, which is the other line on the right axis that spiked. And that's because there were so many investors that were long the yen, long the dollar, sort of short the yen, expecting the yen to weaken and profiting from this carry trade. And that unwound rapidly because 2 things happened. The Bank of Japan seemed to move to a more aggressive, tighter policy stance, and the Fed was expected to cut rates more and eventually move off of this really tight monetary policy.
Right, because after we saw the jobs report, which you referred to, CIO, our economist, Brian Rose, changed our forecast to 100 basis points cuts by the Fed before the end of this year, when before that it was 25 or 50. Is this over, or could there be still more vol in the future, given that what we know has happened in the last week could continue to happen?
Well, I think there was a bit of a misread on all that happened on that weekend, and it was happening rapidly. So
overblown, would you say?
Yes.
Okay.
Very much so. We did have a reversal in the yen carry trade. That happened, but because the yen carry trade, these assets were not just invested in U.S. Treasuries; they were invested in AI and technology and in the Mexican peso. When these trades were unwound, it affected other parts of the market. It wasn't just affecting rates markets. It was moving into risk assets. And so when you had the sell-off, this is important. We didn't talk about this, but it matters. The Japanese equity markets were off 12%. Why? Because the yen strengthened. And so exporters this is the worst sell-off in the equity market in Japan since 1987. Right. And 1987, if you've been around long enough, you'll remember that. But in the U.S., our view, and I think this has become much clearer, we've had an opportunity to restate it, is that we do expect the U.S. economy to slow, but not to contract. This is not a recession that we're expecting, just slower growth. And if anything about Brian Rose's view on the Fed cutting interest rates more, it's really about just cutting it back to something that's more neutral and not having a funds rate that's as tight as it is now. So, I think that these recession concerns, this fear factor, this blood in the streets that we saw is overblown. I would say that we should expect things to be volatile. I mean, let's face it, this yen carry trade probably has seen a lot come out of it, but maybe it's not totally over. We have an election coming up.
A lot of uncertainty there.
Right. So
we have another jobs report, in September, and of course the rest of the year. But before we get the September Fed meeting, which we expect they're going to cut 50 basis points.
Total for 100 basis points. This sounds like a lot. Starting with a 50 maybe sounds like an aggressive move to begin with. But let's put it into context. The Fed also raised rates aggressively, and it has left them there in restrictive territory. It may not be at the point where the Fed can say game over on fighting inflation either. So we're seeing the Fed moving back to neutral, but not moving to a point where it's outright easing. I think that's interesting because it's not about a recession yet. And there have been, I don't want to get too far out of field, but there have been a number of recessionary calls just based on the unemployment rate having moved a large distance in a short period of time.
Yeah.
And that is a trigger for a recession. It has been in the past. Let's remember, these are rules. Rules are meant to be broken. We're still reopening from a pandemic. We should imagine that things might be a bit different in this environment that we're reopening from a pandemic.
You know, we probably overuse the word unprecedented, but what you just described coming out for 4 years out of this pandemic, unprecedented territory, you know, nothing like that had happened in 100 years, and now we're in modern times. It's hard to say what's the path that the markets will take or the economy will take after something we've never gone through before.
I think we should not necessarily be applying rules that have existed in the past to a time when it's very different from the recent past and in the distant past.
Right.
This rule worked. Yeah,
Excellent.
that's right. Yeah.
Kurt, thank you. I wish we had more time. I'd be sitting here with you talking about it. It's a great conversation, and I think the fact that you so clearly described using those examples of the two banks, the yen carry trade, I think that'll help a lot of people to understand the concept behind that strategy.
I hope
so.
it's
Thanks.
helpful.
I definitely feel it was.
Good.
Thanks, Kurt. Great to see you, my friend.
My pleasure.
Kurt Ryman from the Chief Investment Office. Thank you all for joining us. There's more information from Kurt and the rest of the CIO team available on our Insights website. That address on your screen, ubs.com/views. Plus, you can follow UBS on social media, all the major channels, including our Instagram channel at UBS Trending. So give us a follow there. And don't forget, if you want to continue this conversation, and we encourage you to, make sure you're talking with your financial advisor. Until next time, I'm Anthony Pastore. We wish you a great rest of your day. And remember to keep your eyes on what's trending. We'll see you soon.